Hello and happy National Black Business Month. I want to welcome everyone to another edition of Thursday's Edge. Today's webinar is Selling a Small Business and Succession Planning, presented by our USBC partner, Truist. Now, I'm your host, Philip W. Dunn, one of the program managers with USBC. On behalf of our president, Ron Busby, our board, and our staff, I want to thank each and every one of you for your continued support of USBC and your support of our sponsors and our partners. And I'm joined today by representatives from our very special partner, Truist. We at the USBC are very proud of this partnership with Truist, as they are working to inspire and to build better lives and communities by empowering their clients with more choices, more fulfillment, and more hope in our communities. Now, we share in their belief in the power of what we can all achieve together. And so this is perfectly aligned with our ambitions at the USBC as we work tirelessly to create opportunities and improve outcomes for Black-owned businesses just like yours. Now, today's representatives, T. Weaver, our returning champion, T. Weaver, who was with us a couple of weeks ago, and Calvin Ward, a newcomer, who is going to share a little bit of messaging on how to sell a small business and, of course, on succession planning for small businesses. Now, I also want to give a special shout out to my good friend, Shanaria Ashley, who's the VP at Truist. I want to thank you all for taking the time today to spend with us, but I want you to take plenty of notes and listen in for some of the key messages that they delivered today. I think it's going to be very important as you develop your businesses and you're looking to sell your businesses. This is where you can get that information. Now, a few housekeeping items before we begin. You all are encouraged to network within the comments feature. Please do that. You're also encouraged to use the Q&A feature for any questions that you may have. Now, we'll make sure that all of the relevant questions are shared with Truist for their response where possible. And then after that, want to make sure that you all visit our USBC website, some of the on-demand content and some of the live information that we have, such as our webinar opportunities that we have planned for the entire month of August. Now, for the entire month of August, I forgot to mention, we have our webinar scheduled for Black Business Month, in which Truist, again, will be taking the lead to share more valuable information for our member businesses with one more webinar set for August 19th. So lastly, I want to please make sure that we don't share any sensitive information, such as bank account information or transactional information in the chat. We certainly welcome you all to reach out to our Truist representatives, as they will share their contact information at the beginning of the program. So with that said, we're ready to begin our program, and we're going to turn it over to T. Weaver from Truist. T, how are you?
I am doing good. Good afternoon, everyone, and thank you so much for joining us again. We are excited to be here to share a little bit of knowledge about business succession planning and giving you a little bit of tools that you can utilize as you get ready to exit out of the business or even considering selling. The great thing about being a wealth advisor is that we have the opportunity to see so many different clients in different industries and really help them throughout that process. So once again, thank you so much for joining. What we would like to encourage you to do is to not be shy. We're here to answer all of your questions that you have. So at any time, you could put it in the Q&A box or you can put it in the chat box. I will be monitoring the chat box throughout the presentation. So feel free to jump in and ask any questions. That is actually one of the ground rules that we have here, is to relax, learn, and ask questions. So if you go to the next slide, I would like to just go over I would like to actually introduce my partner in crime. His name is Mr. Calvin Ward, and I'm going to allow him to introduce himself to you all. And then what I'll do is I'll just share a little bit about my background as well, and then we'll jump right into the presentation. Mr. Calvin.
Oh, thank you, T. Good afternoon, everyone. Calvin Ward, 30 years of banking experience, a native Chicagoan, now living in Atlanta in the dirty South. Have been in banking for a number of years and primarily working with business owners, small and mid-sized businesses throughout my career as a commercial banker and now as a wealth advisor. Looking forward to passing on some knowledge. Would encourage you all to please ask questions. T and I could certainly just kind of go through the slides, but it's more beneficial if you tailor it to specifically what question that may be most burning in your mind as we go through the material Look forward to working with you all, and thank you for having me this afternoon.
Thank you. Now, a little bit about myself. Once again, my name is T. Weaver, and I've been with Heritage BB&T, but now Truist, for over 10 years now. And I have enjoyed my journey throughout the company. I've worked in several different capacities with the company, as from managing branches to working with small businesses such as yourself for a stint of 2 years, helping you develop strategies and plans as it relates to growing your business. And within that 2-year time frame, I decided to go back to school and get a master's in wealth and trust management and transition over to wealth planning for our clients. So I would say my career path throughout Truist has been amazing. It allowed me to learn so many different aspects as it relates to our commercial clients, as it relates to our retail clients, and then also our small business clients. Outside of Truist, I own my own nonprofit that teaches financial literacy to our kids, and it's called Fly. And I am involved in a lot of different organizations. In my free time, my hobby, I love working out. I'm a huge Marvel fan, so Disney, Marvels, movies, all of that. That's all me. I enjoy it. So I always like to share that personal information with anyone that I'm encountering, just in case you want to tell me a good show to watch. So thank you again for being here. It seems like we have a very intimate crowd today. So what I would like to do before we get started, if you're up to it, if you can put your name inside the chat box, also put the name of your business inside the chat box, so that way we can always create some type of networking opportunity as well. So let's jump into it. So today's topic is business succession planning. On the last conversation that I had, I think it was maybe 2 weeks ago, I mentioned the reason why someone would start a business, right? Why would you decide to go into business for yourself, risk it all, like literally you're your own manager, you're working 24/7, 365, or 366, depending on a leap year. You're working constantly for your business. One of those reasons that I gave was to leave a legacy, right? So when we think about leaving a legacy and we think about why we got into the business, that same concept will come in mind when we're thinking about exiting out of the business. So some of the objectives for today is for you guys to understand, when you do decide to exit out of the business and you decide to sell the business, close the business, or hand it off to someone else, what does that process look like? The change in ownership, what does it take to change the ownership of your business? And then before you decide to exit out of the business, you may want to decide to develop an exit strategy for retirement. Because if you're working within a business and that business is supplying you with income, once you transition out of the business, whether you sell it for multiples of what you put into it, or whether you decide to take distributions and allow the person that's purchasing the business to pay you over a period of time, you still have to have some type of strategic plan in place for the transfer of ownership, but also the transfer of the property itself, but taxes as well. So we want to talk a little bit about that as well today. Next slide. So here's where I get to engage you all. So what do you know or want to know about selling a small business or business succession planning? So if you're bold and courageous and you want to kind of put that inside the chat box, tell me, what do you want to learn about selling your business and exiting out of the business? Or if there's anything else that you're looking to seek from this conversation, you can put that inside the chat box as well, because we want to make sure that we're addressing all of your concerns and your needs. We're here for you guys today. And you can think on it, take your time and think on it. There we go. So we do have well, I actually feel this is a great question. Is selling a business also selling your business debt? That's a really good question. And we would actually tackle that throughout the presentation. Next slide. So why sell the business? Sometimes individuals are in a business for a very long time, 30 plus years, and they have to come up with a reason on why they think it's the best time for them to exit out of the business. So why should you sell your business? Business or professional reasons may include that you may have gotten a really good offer that you can't resist. Another one of my favorite shows would be Shark Tank. And individuals go on Shark Tank and they have this very, very creative idea and they're the creator, but they are not sure on how to execute the idea to generate money. So sometimes on Shark Tanks, the sharks will actually offer the individual a lump sum to purchase their business, but then also offer them contingencies as far as hiring them as employees or as an employee. So with that being said, you may receive a lucrative job offer, you know, from another company to purchase your business, but also you can maintain employment with that company. You may also receive a promising offer to purchase your business and your business assets, along with the business debt as well. The sales and profits are maybe just not enough to meet your needs. I know a couple of clients that held on businesses for too long, and it really kind of put them in a negative versus selling when the opportunity was there for them to sell. So I think it's important to always evaluate that as well. And then when you think about the market and how it is changing, let's consider where we are now. This is a market that is very, very unusual. I know here, I'm located in Charlotte, North Carolina, and here in Charlotte, North Carolina, businesses are constantly selling that you would never thought that would sell. We have a place here called the Chicken Coop. And the Chicken Coop is very known. It was a family-owned business for 60 years. It was announced on a Saturday that they were going to be closing on a Sunday, the next Sunday. And the article shared that the business owner itself just said it was time to exit the business. You know, they've been in business for a very long time. But then later on, the reality of the situation was he got offered millions of dollars for the location of where the business was located. So I think it was maybe $25 to $30 million. So he understood that this was a market for real estate, like real estate developers, and a lot of liquidity is in the market now. And as it relates to real estate in general, this was the perfect time for me to sell the business. It could have always also been that he's been in business for a while and he was ready to retire. So everyone has their right number that they're willing to exit out of the business for. And I think it's important to early on understand what is that number for you. Next slide. So as we continue to talk about why we would sell the business, I shared a little bit, you know, on the previous slide. You're ready to retire. You're ready to retire. I know I have, you know, a very, very long time before I get a chance to retire, but I will tell you this, I'm ready to retire today. But if you're a business owner, some people are considering, you know, they're just ready to retire because they put all their energy, their soul into this company, and now they're ready to transition out and really enjoy the rest of their life. They're burnt out for working for yourself. Once again, when you work for yourself, it's 24/7, you know, 365. There's no vacation per se that I know that a lot of business owners take. Another reason why people transition out of the business is they may have personal issues, health, you know, family needs, or they desire to take a new direction as it pertains to their life. I believe the conversation I had on our first call was people start businesses because they want to leave a legacy. They want to generate wealth for their family or have something to pass along, or they want to generate additional wealth for them, or they're passionate about something that they're entering in. So sometimes it's hard to exit out of the business if you really don't understand the why of you selling it. So evaluating your why is always going to be important when it comes to you transitioning out of the business. Next slide. So this is another discussion point of what is the main reason that you think that you would sell your business. And there may be business owners on the call today that are not even, you know, considering selling the business as of right now. But when you do get to that point of selling the business, think about the main reason, not multiple reasons, but what is the main reason on why you would sell your business? And business transitions doesn't mean that you're selling to a third party all the time. You can still have that legacy that you're creating and transfer that business over to your children, niece and nephews, family members, even to your employees. So if you have a group of individuals that's been working for your company for years and you want them to have ownership within the company, that is an opportunity for you to transfer ownership to your employees as well. So I think it's important, even if you're 10 to 5 years or even 20 years away from transitioning out of your business, to think about the main reason on why you would. So what we're going to do, I believe that just provided you an overview of why you would sell your business, what would prompt different people to sell their business. And what we want to do is talk about the steps. So let's get into the weeds of the steps of actually selling the business, what you need to know. So I encourage you to take out your pen and piece of paper or your iPhone, however you decide that you want to keep notes, and take notes on these steps of actually selling the business. So first and foremost, we need to determine, is the business sellable, right? Just because it's valuable to you doesn't mean that it's valuable to another person. So in order to sell your business, you really have to understand if you're profitable. So we need to understand, do you have strong profits? Is it even an attractive industry? Like, let's say something that's obsolete. Let me think. Flip phones. Like if you have a business that's catered to flip phones, that's not an attractive industry, even though things from the past is coming back in style, right? You have to understand, is it an attractive industry for you to actually sell, and will someone pay for it? That leads into the next bullet point. Do we have a potential buyer? Are there potential buyers that you have identified that really would want to purchase your business? Are your assets good? Your equipment that you may use, is it a value that you put on your business or the assets in your business that's going to be quality to someone else? Do you have quality inventory, or is the inventory have dust on the shelf that is not moving and circulating throughout to the next person that want to purchase it? And I think that is very important to determine when you are evaluating your inventory, you're evaluating the cost of the asset, the value of the business as well. And then who do you want to transfer the business to? Do you want to transfer it to a child? And I think it's having the conversation too. That just sparked something in my mind. Having the conversation with your children if they want to take on the business. I think a lot of time parents assume that my child works in this business, they have the same passion as I have, and they're going to take over the business once I decide to exit out. And then when you start having to have those detailed questions or detailed conversations with the kids do not have a desire at all to take over the business. I'll give you an example. I'm a person that loves to give examples because I want you guys to go back and relate to it. There's an optometrist here, and for the longest, they wanted their daughter to take over the business. But in my conversation with the daughter, she has no desire of taking over the business at all. She would want to keep the business and maybe hire someone to manage the business, but she does not have a desire to be an optometrist. She does not have a desire to run the business at all. She just want to make sure the asset stays within the family and she's profitable for it. So having that conversation with the daughter and helping them understand the disconnect in that family structure allow the owner to think outside of the box of, if I need to sell my business, my child doesn't want to take over it, but maybe I can sell it to someone else, maintain a certain level of equity, which will still create a legacy for us. So I will always encourage you to have the conversation with anyone that you're thinking that would take over the business, because it may not be that they would want to do that. And lastly, the last bullet point is, do you have a healthy balance sheet? So Phil put inside the chat box, does selling your business also mean that you're selling business debt? Typically it does. There may be some agreement that you and the buyer would come up with, but typically it does. And if you have more debt than income, would someone really want to purchase your business if it's not really profitable. So that's something to consider when you're thinking about transitioning out of the business. But ultimately, you will want to create a plan and a strategy in place to make your business more desirable for someone to purchase it if you know that you're wanting to exit out of it. Next slide.
It's me.
So I'm going to hand this over to Mr. Ward to continue on with the conversation as far as determining the price of your business. Thank you.
Yes, thank you, Ms. T. So again, good afternoon, everyone. This is a great slide. As I was taking notes, someone asked, how many periods of profitability do you need? And there is no set number or answer to that. Most people that are buying a business want it to be profitable. They want it to show profitability because they're taking it over. And if the business has reflected a number of years of losses, you're less likely to drive the price down that someone would be offering you. And so we would encourage you to work with your CPA to make sure that oftentimes small business owners are guilty of this, and that they get with their CPA and they think about it, their business from a tax perspective, which means I'm paying less in taxes. But what that also does is that it could show that your business is not profitable if somebody does not dig into the numbers to understand that your business may be more of a lifestyle business and you're running all of your personal expenses through your business. So make sure that once you start to contemplate the sale of your business, you start to treat your financial statements or keep your financial statements with that in mind. Determining your price. And the first thing that comes to mind always is when you determine your price, how do you make sure that that price is appropriate? Just because I may value my business at, let's say, $5 million does not mean that the next person will also hold that same value. When working with some clients in the past, this is a true story. It happened about 2 years ago. There was a successful doctor's practice and they got excited. Somebody came in and said, we're going to offer you $50 million for your practice. The doctors were excited. It was higher than they thought that it was going to be. And one of the other doctors was banking with a different firm, and their banker was like, are you sure that that is really what your business is worth? And so the doctors paused, allowed the other firm to come in and work with them and evaluate the actual value of their business. And it turns out that they would have sold the business at a huge loss to them from a revenue perspective. They ultimately sold the business a year later for almost $300 million. So it's important that you really get a good handle on what your business is worth. Your CPA can put that together for you, or a bank that has a business valuation team can certainly do that for you. One of the determinant factors in determining the price of your business is valuing your revenue stream. T mentioned earlier, if you're going to retire, what is that number? And if you've really lived on the value of the profits of that business over time, is the number going to allow you to live and have that same lifestyle that you may have grown accustomed? So we had, there are examples all the time of small business owners. Somebody comes in and says, I'm gonna give you $5 million. Well, your business may earn 500,000 a year. So you go, okay, that's 20 years, but is that the true number that you should be looking at, or are you underselling your business? So we look at net profit over time. What is the net profit of the business? What are your projections for your business from a profitability standpoint? All that factors in to determining the price that you ultimately sell your business. Valuing the assets. Cash is easy. Cash is what it is. It's cash. If it's $100,000, it's $100,000. There is no up or down markup for cash. It is a flat value, if you will. Receivables. How have you collected your receivables? Are they current? Keep in mind that any receivable that is over 90 days is considered uncollectible and will be severely discounted. So just because you have, let's say, $1 million or 500,000 in receivables, and if we look at your aging schedule and it says that you have not collected on those receivables, they're going to discount that line. You also heard T mention inventory. Is your inventory turning or is it collecting dust? That also goes into to impact the sale of your company and determining the price of what you're trying to sell. If it's a fast mover, a few years ago, you know, everyone was hot on moon rocks. It was a fad 20 years ago. And so companies were selling moon rocks. And then the market fell out and people were stuck with a bunch of rocks that they couldn't get rid of. Or, you know, those Teletubby babies, anything like that, that is quickly a fad will be heavily discounted. Equipment. Is the equipment new? Is it something that that business absolutely has to have to function? And the last point is real estate. This is a good one. If you are a business owner and you own the land on which your business sits, a strategy that I recommend is to separate the real estate from the business. You can sell the business and then rent the land or the building to the new owners. And that you're creating a revenue stream for yourself, ongoing revenue stream. Rent is a great income source. There's nothing that says that you have to sell the real estate as well as your business and own the real estate separately from your business. Keep the real estate in its own LLC and then pay yourself rent. That way it'll show on your financial statements that the real estate is separate from your business itself. And all of that goes into determining the price. And then the numbers are put together. Remember, every value or as much value that you can generate in your business is helpful for you. So make sure that if you're carrying dead inventory, once you make the decision to sell, these points become utterly viable and important. Receivables. If you haven't collected in 120 days, write it off. It's not going to happen. Inventory, if it's stale and old and you know that there's no market for that, get rid of it because no one is going to give you value for it. Equipment, if it's part of running your business, that always has a value. Real estate, segregate the real estate from your business and treat them as two separate enterprises. Next slide. Preparing for the sale, resolve problems. Make sure that there are no product channel conflicts, that you're able to make sure that deliveries are on time, that you have no issues with creditors or people that manufacture your inventory if you're a distributor. Accounts receivable, as I mentioned earlier, can they be collected? Are you collecting them? Prepare financial statements. Make sure that your financial statements are what we call high quality. Normally, everyone says get an audit. If your business is small, an audit may not be price feasible, but get reviewed statements or compile statements that have been done by a CPA. And you know, software is great, QuickBooks is fine, but when you're preparing for a sale, typically the seller wants to have a little more confidence in the financial statements that you're presenting to them. Provide a business plan. That's more along the line of if you're starting a business, people want to look at your business plan. Typically, if somebody is offering to buy your business, they have an idea of what that plan is going to do. I wouldn't fuss over a business plan if you don't have one and you're contemplating a sale, but you should be able to defend how you've marketed your business and why you believe that your business is viable in an ongoing relationship. Secure relationships. Make sure that your clients will transfer over to the new owner. Are they based on friendships, or are they based on the fact that you present or you have a great product and they're going to continue to buy that product no matter who's in the whose name is on the door? Make sure that your equipment is in good order. Nobody wants, and trust me, before you sell a business, the person who's looking to buy your business will come in and kick the tires, look at the equipment, look at your receivables, look at how you're paying your bills, look at everything in order to make sure that what they are buying is what they believe they are getting. And then how will you be compensated? Is it a stock sale? Somebody mentioned earlier, do you buy debt? Typically, the more debt you have, that factors against the money that you receive. So sometimes it's companies have been sold because there was so much debt. The owner said, hey, just take me out from under all this debt and give me a few more dollars and the business is yours. So there's a thing of being overly levered to the point where you really can't sell your business because you have too much debt, unless your product is outstanding. Now, there are businesses that grow really, really fast and they can't keep up. And so they've taken on more debt to create more revenue. That again is a rarity. And so you just want to be mindful of how much debt that you're taking on once your mindset hits that you're going to sell your business. And make sure that you have a good team in place before you sell. A good CPA, a business attorney, an estate attorney, which we'll get to later when we're talking about your retirement plan, a banker, and a trusted advisor. It could be a financial advisor, or it could be a risk management person, but you need to have at least 5 to 6 people that you are paying that are part of your team that you've set up, because those are the individuals that you pay, and hopefully you are trusting them to give you a good idea of what you're going to do in the future as you prepare your business for sale, and then how do you take the proceeds from that sale. Next page. Look for prospective buyers. T mentioned this, and we'll always say a lot of times small business owners don't look internally. If you have an employee who's been with you for years, have that conversation. Would you be interested in taking over the business? And if they say no, they say no, and then you move on. At least you will have looked internally first. Are some of your customers potential buyers of your business? Recently, one of my clients got an unsolicited offer from one of their customers, and who said, I like how your business operates. I'd love to buy you out. And what the customer was doing is saying, if I get this piece of the business, I get a big chunk of the Southeast. So there could be customers of yours that will say, hey, I wouldn't mind buying out your business, or buying a share of your business, if you will. And that's another conversation. Is it an outright sale, or is it a sale where you give equity or ownership to whoever's looking at buying your company? Other business owners, competitors. A lot of times competitors will look to buy you out. Depending on if you're a small fish in a big pond, sometimes people will arrange a buyout to increase their market share, because you may have 5%, they may have 5%, but if they get to 10%, it gives them a super discount and they're willing to pay that. And oftentimes when a company is being bought out, banks can arrange financing. And so when you're looking at a potential sale, start with your banker to say, are my financials, and because if you're borrowing money from your bank, I can almost guarantee you that your banker is looking at your financials with a close eye, going, yeah, can I, are these numbers accurate? Because we're lending you money. So we're providing debt for the operation of your business, and we're cash flow lenders. So we want to make sure that there is sufficient cash flow in that business to cover the debt. And so oftentimes, when companies are bought out, it's a bank or a private equity firm that's providing the financing, depending on the relationship that the person buying the other business has, whether it's a private equity group or a bank financing. Typically, if it's a bank finance deal, it's another competitor who's buying out your business. Private equity groups tend to be doing what we call a roll-up strategy, which means they're taking your business and adding it to a portfolio of other like companies or different companies, so that they want to have ownership in that particular space. Next slide, please. No, negotiating the deal. This is one of my favorite. This is where you lose money if you're not prepared. You heard me mention a person walks in and says, John Smith, I've been watching you from afar. I'd like to buy your business for $10 million. And you're like, wow, sounds good. Let's do it. This is more money than I've ever thought about for my business. But what's the key that I mentioned earlier? You have to understand what the value of your business is before you sell. So it doesn't hurt to have a business valuation done every 3 to 5 years, just to see where you are in the marketplace as your business has grown. And oftentimes markets change. Just because your business is hot today does not mean it is tomorrow. COVID has created a lot of pent up demand and cash that's swirling out there. So people are paying a little higher multiples. When and if ever we get COVID under control, multiples may come back down, but understand your price. Understand who's offering to buy you. Are they legitimate? People walk up all the time and say, I want to buy your business. Doesn't mean that that's a good buyer for you. Understand that sometimes, and it's okay to say, no, I'm not interested. There's no problem. I had a client a year ago, was all set to sell his business. And it was a larger company that was going to buy him out. And the company invited this gentleman and his wife down to negotiate, to talk about the final deal. And they were all supposed to go to lunch together. And at the last minute, the bigger company said, nah, I can't do lunch today. And that ticked off the guy. He said, I'm good enough for you to buy my company, but not good enough for you to break bread. Now that was his wall, his line in the sand that he had. So he disqualified that buyer. He just said, no, I'm not interested. The offer that they were going to give him would have been a equity buyout, which they would have owned 60%. He would have owned 40%, because they wanted his client list, and his clients were loyal to him. So they wanted to keep that loyalty in order to grow the business, but give him more equity to buy more equipment. But at the end of the day, as he looked to qualify the buyer, he just said, no, I'm not interested. Something in my spirit will not allow me to move ahead with this purchase. Lump sum versus installments. Again, this is part of your planning. It's like the lottery. Do you take it a lump sum and get out? Or do you take installments, and perhaps the value of those installments diminishes over year, time value of money? Again, when you're looking at that, part of it is having a bank or financial advisor on your team who can really advise you as to what is the best strategy. And typically, if it's installments, it's based on the fact that they want you to stay on board and operate the company for 2 to 3 years. And so they're giving you an earnout. And part of it is have an attorney review the earnout. We've seen a number of earnouts where they give you 10 million up front, and then they offer to split profits 50-50 for the next 3 years. But what they don't disclose to you is the way that they do accounting, there's never going to be a profit. So the 10 million is all that you're going to walk away with and hurt feelings because you've given them an additional 3 years with the intent that you're going to collect at least another 3 to 4, $5 million, and you're not able to. Non-compete clauses happen all the time. If they buy you out, you're such a force in that business. They don't want you to start another company. So there could be a clause in there on a non-compete. There's nothing to be afraid of those, but if you see one, make them pay you for the privilege of your sitting out for a year or two. Management assistance, again, typically it's on an installment. Down payment, would never touch that one. Everyone should be able to pay you out in cash. If it's a down payment, that means you as the owner of that business still have skin in the game, and there's a lot of risk. What's the collateral involved in the transaction? Is it cash? Is it stock? Are they buying all the debt? What have you? Next slide. The next question. So what are the challenges of selling your business? And T, I know we're running short on time, so we'll just blaze through that. If you want to put that in the chat, we'll try to address that toward the end. Next slide, T. Steps for closing a business. Make sure that you follow all the instructions. Once the attorneys have said, yes, we agree to terms and this is how we're going to do it, follow the instructions and whatever the founding documents will be, because that will make sure that you've closed all the back doors. How are the business assets going to be disposed of? Is it part of the sale or are those assets to be sold off? This cancel permits, licenses and lease agreements. If that's not a part of the transaction, you want to get all of that out of your company's name so that you're not liable for the ongoing concern once the business is sold. Make sure you comply with tax laws. The worst thing that you can do is sell and then you forget to pay taxes, and now you're in another bad situation. Resolve outstanding issues with customers, suppliers, and creditors. That goes with that. Just make sure that when you're transitioning or selling the business, that you give it a clean bill of health. Keep your records up to date. And I mentioned this at the beginning, but is at the closing point here is get professional help. Never assume that you can do all of those things on your own. Be an attorney, be a tax person, be your own banker. I would say that when you're selling a business, unlike buying a car, get help. Don't think that I've bought cars all my life, I can do this. Well, there are too many things that can trip you up when you go to sell a business or transition a business that you want to have a third set of eyes looking over your shoulder. Next slide. Planning succession. I think T mentioned this is starting once you've made the decision to sell. What does that look like? Are you going to retire, or are you going to continue to run a business or start another business? Next slide, T. So this is more of if you're going to keep the business in the family, making sure that you've had that discussion with those individuals to make sure that they are willing to run the business. Because if you identify that you don't have a successor, that means you're going to sell your business to an outside party. Next slide. This is great. issues in succession planning. This is whether you're going to sell the business, transition the business, or retire. Start early, start early, start early.
And Calvin, if I can, if I
Sure.
can add in here, I would want you to spend a little bit more time on this slide here.
Okay.
Because it's important to plan ahead. I don't know if we have business owners who are looking to exit out of the business right now on the call, or business owners who are gathering information right now to make sure that they're setting up everything in place to prepare for the sale. So if you'll spend a little bit more time on this slide, it would be greatly appreciated.
Certainly, certainly. So again, start early, identify successors. If you are transitioning your business to someone who works in your business, make sure that you do a brain dump or a brain meld, so that oftentimes if it's a family-owned business and your kids are running your business or planning to run the business, make sure that, just like in The Godfather, he was training Michael to take over the business, albeit an illegal business, but the process still works the same way. And that you want to make sure that that person knows as much about the business as you do. You know, who are my biggest customers? Have I made entree with those clients to make sure that the clients will value the person I'm choosing as my successor the same way that I do? Have I trained them to make sure that they know how to deal with the bank? Oftentimes, when it's a family-run business, the owners deal with the bank and they never let the other parties get involved with negotiating with the bank or with the attorneys or with any of the large vendors. And you want to make sure that now you expose them, because if you're transitioning the business, let's say to a trusted employee or one of your children, you want all of your partners to be very comfortable with that individual. The one thing that I will tell you has synced transitions is that a person has anointed a successor and the bank does not like that person, the attorneys don't like that person, the vendors don't like that person. And so you've now transitioned the business, and a year later the business folds because that person has no support group around them to make sure that they're going to be successful. And sometimes when you're transitioning to a family member, you want to have a trusted employee stay on to make sure that that person is going to be successful. Doesn't mean that the key person is a manager, but somebody who's been around in that business long enough that can then share that knowledge with the next generation of who's going to take over the business. And tax exposure, and this is really more, how do you take the assets? Is it a full-on cash where I get my money and then bounce? And the reason you're planning for the tax exposure is that if you're working with an estate attorney, there are tax mitigation strategies where if you're charitably inclined, you can take part of those proceeds and put in a donor advised trust or a foundation. People love foundations, but I'd say a donor advised trust, because you don't have the same tax hurdles where you have to distribute the funds 5% until you make a decision. But a donor advised fund, or giving it to your favorite university or your church or whomever, you can minimize the tax exposure by your charitable contributions or donations using some of those proceeds. And so if you've ever wanted to make a big gift to your alma mater, that would be the time to do it with those proceeds. And then get legal advice. You heard me mention a business attorney, not a real estate attorney. You want somebody that has closed deals and helped businesses sold, because what happens is that attorneys will always tell you that they can do every and anything. You want a person who has dealt, the majority of their practice should be business transactions. Nothing wrong with the real estate attorney, but what part of their practice is in business development or working with business owners and the sale of businesses? Because there's a lot of paperwork that goes back and forth, a lot of innuendo in those documents. and you want to make sure that your attorney is giving you the best advice. The estate attorney can help you with the tax exposure. T, anything that you wanted to add for this one? Oh, planning retirement. Go ahead.
No, actually, you did a great job. I just thought it was important to slow it down and actually plan ahead, right? Talk about planning ahead, making sure that you identify the successors, train the successors, and then understanding the tax consequences as well as succeeding out of the business. So no, you did a great job. Thank you. For that. And we're wanting to leave time for any questions and then actually go back into the chat box and answer some of these questions to open up dialogue. We realize that business succession planning is not the sexiest topic, but it is very, very important. So we can go ahead to planning for retirement. The next slide, thank you. All right, so when you think about owning your business, yes, the sale of your business typically is the main retirement plan that individuals have. However, it is always encouraged to diversify, right? When 2020 hit, I know a lot of small business owners, and we had to shut down for several months. A lot of small business owners were very, very worried. They were worried on if they were going to survive, if they were going to be able to continue to progress with their company and even retire from their company. So with that being said, it's always important to have some type of secondary plan as relates to retirement plan for your business. So a couple of common retirement plans that we typically put in place for our business owners would be SEP plans, simple plans, and 401k plans. All of these are different types of retirement plans that offer different contributions amounts towards them that in turn, a lot of business owners don't know this. But let's say, for example, you open up one of these retirement plans and you make a contribution to one of these retirement plans. Your company actually gets a tax deduction for the contribution on your behalf. And the funds get an opportunity to grow tax deferred, right? Or tax deferred over a period of time until you access those funds after the age of 59 and a half. So there's some tax benefits from opening up this retirement plan. Even if you're a small business owner, there's some tax benefits from that. And of course, we always like to refer you to get professional help. Even if we are wealth advisors and we know these topics, they change every single year. Tax laws change every single year. So anytime I have a conversation with my clients, I always recommend that they talk to their CPA about just setting up these plans, understanding it a little bit more, and then how it will be more tax benefit for them if they were to open up these plans as well. So just wanted to highlight there. We can go to the next slide. So the top 3 key points that we want you guys to remember today, and we said it over and over again, is to plan. So plan for the possibilities of selling and closing your business or just transitioning your business and making sure you have the right key partners in place. You don't have to know everything. The key partners are not going to know everything either, but they're going to be in place for their area of expertise. Start by making the plan as soon as possible. Even if it's a 5-year to 10-year outlook, go ahead and start making those plans because time does fly by really, really fast. And you may have to shift or change those plans, but just depending on the direction of your business, the expansion of your business. And then the last bullet point is create a retirement plan for you and your employees. And when I say you and your employees, there's plans that allow you to contribute to your employees' retirement plans. That would be a tax deduction for the business as well. But just creating an alternative plan for you outside of selling the business and the business being your main asset. So interesting fact about Calvin and I is that what we do on a day-to-day basis for Truist is we help business owners who have a $10 million business value or more plan for retirement. And we're starting from 3 to 5 years to maybe even 7-year period, helping these clients put things in place now. So when they decide to transition out of the business, it's going to allow them to make an easy transition. There's not going to be a lot of hiccups. There may be some, but not a lot of hiccups where it's going to prevent them from selling the business as needed. And particularly these business owners don't have a lot of liquidity because all of the money is funded into their business. So when they do sell the business as a part of their retirement plan, it will be a huge part of their retirement plan. But we also encourage them to have other things in place that's going to be benefits for them currently. Next slide. So in conclusion, we hoped that you learned reasons for you to sell the business or even to close the business. And I think it's hand in hand. So when you think about why you start the business, right? Why did you start your business? Was it to leave a legacy for your family? Was it to generate wealth? What was your main reason for starting the business? And typically that main reason for starting the business may be the main reason for selling the business too, or transitioning the business. So if you started a business because you want to create legacy, you wanted to pass down something to your family, for you transitioning out of that business may be for you to transition it over to your children. If you wanted to start the business because you know what, this is a great idea, I see market, for this idea, and I'm going to start this business so I can make money. By the time you go to sell that business, your reason for selling it is because you made your money and now you can make more, right? So think about the reason why you started the business, and typically it should be the reason why you're going to exit out of the business. The steps to selling and closing your business, steps to succession planning, we hope that you learned that as well. And then the benefits and steps of creating a retirement plan. We hope we were able to touch on that as well. As we know, we're only here for an hour. So of course we can't squeeze everything into 1 hour as relates to business succession planning or just business dealing in general. So we encourage you to just reach out to whomever your local bank is. Hopefully it's Truist. Fingers crossed, it's Truist. But hopefully, we encourage you to reach out to your banker and start these conversations. And in this PowerPoint slide, which Phil has, and he will send this and share this with you guys, there are some final questions, or if you have final questions, feel free to ask them now, and we'll be able to answer them for you. But if you come up with questions later, do not hesitate to reach out to us, to reach out to Phil, and Phil will filter those questions over to us. So we thank you. Thank you so much for your time. Any questions that we have, or any questions we did not get a chance to answer?
Yes, and I want to thank you both, Calvin and T. This was very informative. Shout out to Joe Carter, who said that this was very helpful information that you all shared today. I did put in place a couple of questions that we typically hear at the chamber. We don't necessarily have that expertise to answer those questions, so we want to get Truist's sort of expertise here. I have a service-based business. I either clean homes or I cut lawns. Over the years, I've developed a strong brand name. Can I sell that service-based business?
Yes, that happens all the time. A lot of times with government contracts, they don't, the business transitions and the person puts a different patch on their sleeve. So yeah, you can sell that business like you would any, and the same steps hold true. Receivables, payables, is the equipment, are the workers dependable, and that whole 9 yards. But no, service businesses sell just as quickly as a regular business, and maybe a little faster depending on the service industry that they are part of at that time.
All right, and I started a business. I fell on some hard times. I still make a little bit of money, so my business is sort of distressed at the moment. If I want to sell it, can I still make a little bit of money on a distressed asset sale?
Yeah, very little. But it depends on everything has a yeah, but. And so, if it's a distress, why is it distressed? Is it because you didn't have enough equity in the business to really drive home what you were trying to do? And so somebody may come in and recognize it's going to take a little longer for you to sell that business, but you can still sell it. There are distress sales all the time. Again, it's what is it that you want to walk away from? Is it the fact that if they cover my debt, I'm good, and then I'm move on? But yeah, we've seen distress sales. You see it in real estate as well. Distressed real estate sales. You're selling it for less than what you probably have in it, But if that's what you want to do to clear your debt and to start fresh somewhere else, yeah.
All right, and then the last question I'm going to throw in here is, I have a business, it's very profitable. I have a large number of customers. No one customer is a major or a large customer. They're all pretty much evenly addressed. Do I have to keep records on my customers before I make a business sale?
What kind of records? I'm curious, because as you were saying that, Philip, I'm thinking as a banker, I love the receivables that person has for their business. That's great because there's no customer concentrations. So I'm not sure of the records. When we say record, that just basically, it was really around receivables, making sure that you're collecting your receivables on time and that you don't have anything that's, beyond 90 or 120 days where it's truly not a receivable. You're just carrying that debt because it looks good on your balance sheet. But most bankers will discount that. But if you have a diverse client base, that's the perfect business to buy. And as a former banker, commercial banker, that is the perfect business to bank.
Yeah, and I'll add in here very quickly. If you're maintaining, like keeping records as far as like clients, and you have a base of clients that constantly comes and gets your products, I would say that it would be a benefit because the person that's purchasing it now have repeat clients that are going to stay with them, and it's an easy transition as well. So I would say that would be a great opportunity to increase the value of your company because now someone is walking in with return clients that they would never have had. And it'd be an easy transition as well to reach out and explain to those clients of the sale of the business that you may not see me as often. I'm selling it to this person, and that'll allow the clients to continue to purchase the product.
That's perfect. What a great way to wrap up this first Thursday's Edge with Truist. I definitely appreciate both Calvin and T for their expertise. I want to thank all of our attendees for dialing in. Calvin, I really do appreciate that Godfather reference. I got to go back now and watch it because, I'm thinking about, me and my son want to start a business. We're not tough guys, but, we might be able to do something like the Godfather. So, but with that, we're going to close, and I'll make sure to edit that out.
It was on the other night, Phil. What can I say? I was just, it was fresh in my head.
No problem. Well, I'll tell you what, on behalf again of our president, Ron Busby, our board, and our staff here at USBC, we appreciate all of you for tuning in, and we especially appreciate our good friends at Truist. You all have a great day and a great start to your weekend. Thank you all.